confident that global peace was actually holding, only to wake up Monday morning to a total shutdown of 20% of the world's oil supply.
All right.
I mean, that isn't some hypothetical scenario. That is exactly the absolute whiplash we've seen over the last 48 hours.
It really is staggering. What we thought we knew when the closing bell rang on Friday afternoon has just been completely upended.
Welcome to the Deep Dive. I'm Daniel.
And I'm Mira.
Looking at the massive stack of research, news alerts, and marking data we're diving into today, our mission is really to just cut through the noise. We want to help you, the listener, understand the macro backdrop entering this new week.
Yeah, and unpack exactly why these weekend geopolitical events broke down the way they did, right?
Exactly. And, pinpoint what actually matters for your portfolio when the opening bell rings tomorrow.
And just to set the stage for everyone, it is Sunday evening, April 12th, 2026.
Yeah.
And, well, the world looks very different than it did 48 hours ago.
It really does. But before we unpack this incredible stack of sources, I do have to explicitly state to you, the listener, that this deep dive is strictly for market context and discussion.
Right, definitely.
This is not personal investment advice or a recommendation of any kind. All right, so let's start with session one. How did markets actually trade heading into this weekend's chaos?
Yeah, we have to trace our steps back to Friday to understand the foundation we're building on. Because to understand tomorrow's panic, we really have to look at last week's optimism.
Totally.
And honestly, looking back at the first full week of April, from the 6th to the 10th, you would think everything was fundamentally sound.
Yeah.
Despite a really choppy session on Friday, the week ended with the S&P 500 up 3.6% and the NASDAQ surging 4.7%. I mean, that was actually their longest winning streak since last October.
But Friday, April 10th is where the story actually starts, I think. Because beneath the surface of those weekly gains, we saw this fascinating micro-divergence on the trading desks.
Oh, absolutely.
By the close, the S&P and the Dow had actually slipped slightly into the red, but the NASDAQ just kept gaining. At the same time, we had Brent crude oil retreating to around $95.20 a barrel.
Which was driven entirely by the hope that the U.S. and Iran ceasefire was actually going to hold.
Right. Meanwhile, the 10-year Treasury yield marched higher, testing 4.34%.
That divergence on Friday is everything. Look, if you look at it through a macro fundamentalist lens, what we were watching was a massive high-grading mechanism playing out in real time.
High grading, yeah.
The market was aggressively rewarding companies tied to the AI acyclic capex cycle. We're talking about this $635 to $650 billion infrastructure supercycle.
Okay, time out. We are throwing around some heavy Wall Street jargon pretty early on here. Let's translate that for the listener. What exactly is an acyclic capex cycle?
Fair enough.
And what does it mean when the market is high grading?
Let's break it down. So CapEx just means capital expenditures, right? Companies spending massive amounts of money on physical infrastructure like data centers and servers.
Right.
And acyclic means this spending is happening regardless of the normal economic business cycle. Even if the broader economy slows down, these tech giants are in an arms race. They just cannot stop spending on AI.
They have to buy the chips or they lose the war. It's that simple.
Exactly. And high grading is a term from mining, actually. But in finance, it means investors are dumping their B-tier vulnerable assets and shifting all their capital into A-tier bulletproof assets.
Oh, okay.
And a perfect example of this hit the wires at 8 a.m. Eastern Time on Friday. CoreWeave announced this massive multi-year infrastructure agreement with Anthropic to deploy their AI models at production scale.
Wow.
The takeaway there, hardware is winning definitively, but traditional software, it is being ruthlessly punished in this high grading shift.
Which brings us to the ServiceNow downgrade.
Right. On Friday morning, UBS downgraded ServiceNow from a buy to a neutral rating. Their core argument was that corporate IT budgets are finite.
Yeah.
And chief technology officers are shifting every available dollar away from traditional non-AI software to fund their AI hardware needs. And on that single analyst note, the stock plunged 7.5%.
Okay, here is where I have to step in as a practitioner because I really have to push back on the severity of that software sell-off.
Oh, here we go.
I do. Look, I want to look at this through the lens of price versus intrinsic value. I want you, the listener, to really think about this. Did ServiceNow's actual long-term intrinsic value, meaning the sum of all its future cash flows over the next 20 years, did that truly drop by nearly 8% between breakfast and lunch?
Right.
just because one analyst wrote a memo about IT budgets.
Look, the academic models would absolutely say yes. I mean, the efficient market hypothesis assumes that new information requires instant rational repricing.
But common sense tells us that isn't reality. Real-world business fundamentals move slowly. An enterprise software contract doesn't just vanish in 3 hours.
I know, but yeah.
What we saw on Friday was an emotional reaction. I like to think of it like a crowded theater. Someone yells, "Fire!" which in this case is the downgrade note, but the exit doors are suddenly locked.
Right.
That's a liquidity vacuum.
Because the algorithms are literally running for the exits, but there are no buyers stepping up on the other side.
Exactly. It triggers stop-loss orders, it triggers algorithmic selling, and the price just drops into an air pocket. It is not perfect market efficiency recalculating exact present value.
No.
It's just human panic combined with computer code.
Okay, I will definitely concede that daily price discovery is incredibly messy.
Yeah.
Academic models assume perfect efficiency, but in reality, yes, markets are bounded by human emotion.
Right.
And, as you explained perfectly, those sudden liquidity vacuums. True price discovery of a company's worth takes time. But while you can debate the efficiency of a single stock's intraday move, you absolutely cannot debate the hard macroeconomic data we got on Friday regarding inflation.
The inflation creep. It's getting harder and harder to ignore.
It's undeniable at this point. Inflation is re-accelerating globally, and we saw the hard proof. On Friday, the U.S. Consumer Price Index, the CPI print, showed a massive 3.3% year-over-year jump.
Yeah.
And it wasn't an isolated U.S. problem. Japan's Producer Price Index accelerated to 2.6%.
Which is huge for them.
It is. It's pushing the Bank of Japan much closer to raising interest rates.
And China's factory gate inflation turned positive, up 0.5% for the first time since October 2022.
Yes, and that is a massive pass-through mechanism. When the cost of producing goods in Chinese factories goes up, that cost eventually gets exported directly to American store shelves.
Right.
It's the ultimate signal that the recent energy shocks are officially bleeding through the global supply chains.
So if we synthesize all of that, we basically left the trading desks on Friday with this incredibly fragile baseline.
Very fragile.
We had high, sticky inflation, we had rising treasury yields, but the market was clinging to this cautious underlying optimism that the Middle East energy shock was stabilizing, right? And that peace talks were working.
Which brings us to the weekend. Let's move to session 2. What happened over the weekend, and how does it fundamentally change our macro reality?
Right, because that exact optimism was systematically dismantled over the last 48 hours. Heading into the weekend, if you looked at the watch next items from our Friday trading notes, the market's eyes were squarely glued to two things.
Which were?
The U.S. and Iran diplomatic negotiations taking place in Islamabad, and the potential for escalations in Lebanon.
And early Saturday morning, April 11th, the market's cautious optimism actually seemed justified. Let's trace the causality here chronologically. At midnight Eastern Time, which is 8 a.m. Gulf Standard Time, we received physical proof that the temporary U.S. and Iran ceasefire was holding.
Oh, the tankers.
Exactly. The first massive supertankers safely exited the Strait of Hormuz via trial anchorage.
Which is a huge deal. A trial anchorage isn't just a political statement, it's an insurance necessity.
Right.
You can't just sail a multi-million-dollar ship full of oil through a conflict zone unless the maritime insurers have physical proof that the route is de-escalated.
Exactly. That provided a huge sigh of relief for global energy markets. And the good news just kept rolling in.
Yeah.
At 5 a.m. Eastern Time, or noon Moscow time, Russia and Ukraine executed a massive prisoner swap ahead of an Orthodox Easter truce. This dramatically eased some of the Eastern European tail risks that commodity markets have been pricing in.
And then an hour later, at 6 a.m. Eastern Time, 2 p.m., Gulf Standard U.S. Central Command confirmed that American destroyers were actively clearing Iranian naval mines from the shipping lanes. I mean, every data point was pointing toward de-escalation and a return to normal freight routes.
But by Saturday afternoon, the friction in the global system became impossible to ignore. The narrative just started to crack at the seams. At 11:25 a.m. Eastern Time, which was 8:25 p.m. in Pakistan, Saudi Arabia, and Qatar had to urgently extend a $5 billion financial lifeline to Pakistan.
Now, you might be asking, why does a sovereign debt issue in Pakistan matter to U.S. equity markets?
It's a fair question.
It matters because of the leverage dynamics. Pakistan was on the absolute verge of a sovereign default right at the exact moment they were hosting these critical neutral ground peace talks between the U.S. and Iran.
You cannot host a stable, high-stakes geopolitical negotiation when your own government is literally running out of money that same afternoon.
No.
It completely undermines the stability of the diplomatic environment. It was a glaring warning light about the underlying fragility in emerging markets under energy stress.
And then we saw that energy stress hit the physical consumer. At 12:36 p.m. Eastern Time on Saturday, domestic blockades in Ireland left roughly 600 gas stations totally dry.
Wow.
This is the difference between paper contracts and physical supply chains. It proved that even developed Western economies were buckling under the commodity shortages.
Which sets the stage for the devastating Sunday, April 12th news cycle. The fragile hope from Saturday morning completely evaporated. Last night, at 11 p.m. Eastern Time, 8 a.m. Sunday in Pakistan, the U.S. and Iran peace talks in Islamabad between Vice President J.D. Vance and Iranian officials collapsed entirely.
Completely fell apart.
They ended without any agreement over the ongoing nuclear and maritime disputes.
There was no diplomatic off-ramp.
None whatsoever, and the dominoes just kept falling. At midnight Eastern Time, 7 a.m. Eastern European Time, that Orthodox Easter truce between Ukraine and Russia that we mentioned, it was violently breached by heavy artillery fire, with both sides accusing the other of thousands of violations. But the ultimate shock, the thing that is going to rewrite the market narrative tomorrow, came Sunday at 2 p.m. Eastern Time.
The blockade order.
Yes.
Yeah.
President Donald Trump ordered a total U.S. naval blockade of Iran and the Strait of Hormuz, which goes into full effect Monday morning at 10 a.m. Eastern Time.
We really need to pause here and unpack the pure mechanics of what this means for the macro reality. Because this isn't just a headline. This is a structural shift in the global economy.
The textbook implications are severe. I mean, this blockade effectively chokes off 20% of the world's global oil exports, period.
Right.
We are looking at an immediate structural energy shock. It guarantees that the inflation reacceleration we saw on the data on Friday is going to become deeply sticky. And fundamentally, it means the Federal Reserve is going to be completely paralyzed.
Walk us through that paralysis, though. Like, why can't the Fed just cut interest rates to help the economy if things slow down?
Because of their dual mandate. If energy costs skyrocket, it drives headline inflation right back up to the highs.
Yeah.
If inflation is surging because of an oil shock, the Fed simply cannot justify cutting interest rates to stimulate growth, even if corporate profits are suffering. They are totally boxed in.
Okay, here is where it gets really interesting, because I have to jump in again with the practitioner view. Yes, the algorithmic trading bots are going to blindly dump stocks on Monday morning.
Oh, for sure.
They are programmed to treat this blockade like a meteor strike, right? Like a random, unpredictable natural disaster that destroys value. But if we looked at this through the framework of geopolitics as human game theory, this isn't a random disaster.
Wow.
This is sequential human posturing.
So you're saying the market misprices the political chessboard?
Exactly. Algorithms routinely misprice these geopolitical events because algorithms don't understand human leverage and negotiation. A public ultimatum, like a naval blockade, is a calculated poker move by rational actors trying to force a diplomatic outcome. Furthermore, because of something called delayed information diffusion, the market is not going to price the nuances of this blockade instantly.
Meaning human beings and institutions have bounded rationality. They can't process all the variables at once.
Right. It takes time for the human brain and massive pension funds to actually digest what a blockade means for supply chains in 3 months. There is going to be a window of chaotic overreaction tomorrow morning.
Yep.
People will sell perfectly good assets just to raise cash. And that chaos is the hopeful edge for active investors who keep their heads, understand the game theory, and look for mispriced assets while the rest of the market is caught in an emotional panic.
Look, I'll concede your point that Monday's opening gap down is going to be driven as much by sheer panic and liquidity vacuums as it is by long-term fundamentals.
Yeah.
True price discovery of a supply shock this complex takes days, if not weeks, to establish.
Yeah.
But the initial panic will be very real. To synthesize this weekend whiplash, we went from supertankers safely moving on Saturday morning to a historic energy blockade being ordered by Sunday afternoon.
Which means we need to look forward.
Yes.
Let's start session 3. Where do we go from here, and what should you be watching as the bell rings tomorrow?
Well, the immediate, undeniable catalyst for the market is Monday at 10 a.m. Eastern Time. That is the exact moment when the U.S. Navy officially initiates the physical enforcement of the blockade.
Right.
All eyes are going to be on the physical crude market's reaction. We need to watch spot Brent crude and see if it violently spikes past its previous high of $110 a barrel. That single price action will dictate the tone for global equities for the rest of the day.
And as we move through the rest of the week, the entire economic data slate is going to be viewed strictly through the lens of this new energy reality. On Tuesday, we get the U.S. March Producer Price Index, or PPI. This data is going to capture the initial wave of this war-driven inflation hitting wholesale costs before it reaches the consumer.
And then on Wednesday, the focus shifts to global demand destruction. We get China's Q-own GDP and industrial production data.
Yeah.
This is critical because if emerging markets are buckling under the weight of higher energy costs, it is going to show up in the Chinese manufacturing and industrial data first.
Then Thursday brings U.S. initial jobless claims and the official kickoff of Q-own corporate earnings, starting with big banks like JP Chase. And listen, I cannot stress this enough. Bank earnings are absolutely crucial this week.
Oh, yeah?
We have this looming unresolved private credit crisis hanging over the market.
We've already seen retail investors trigger redemption caps in semi-liquid business development companies, or BDCs.
Right, and let's explain what that actually means. For those of us who don't spend our weekends looking at private credit plumbing, what is a BDC, what is NAV lending, and why does a software company defaulting trigger a potential crisis at a major bank?
It's a great question because it's all interconnected. Think of a business development company, a BDC, like a bank that isn't officially a bank.
Okay.
They pool money from investors and make highly leveraged loans to smaller or mid-sized companies, often software companies. When those software companies start defaulting on their loans because their budgets are getting slashed, the BDC starts bleeding cash.
And when retail investors see that, they panic and try to pull their money out of the BDC.
Exactly. But these are semi-liquid funds, meaning they could literally lock the doors and cap redemptions so investors can't get their money back.
Right.
Now, where do the big banks come in? The big banks provide the leverage to those BDCs. This is called NAV lending against the net asset value of the fund. Banks also have massive exposure to collateralized loan obligations, or CLOs, which are basically just bundles of these risky private loans.
So if the software companies default, the BDCs freeze, and suddenly the big banks holding the paper for all this leverage are left holding the bag.
Precisely. If bank balance sheets start showing severe stress from their exposure to these private credit markets, things could get very ugly very quickly.
Which makes Friday's schedule even more concerning.
Oh, absolutely.
On Friday, we have key speeches scheduled from both Federal Reserve and European Central Bank officials, and we have to remind the listener of the extreme institutional risk hanging over the Fed right now.
Yeah, people forget this.
Chair Jerome Powell's term expires next month, right in the middle of a highly controversial Department of Justice criminal probe into a $2.5 billion building renovation.
It's completely unprecedented.
It is, and the nominee to replace him, Kevin Warsh, just had his confirmation hearing indefinitely delayed by the Senate Banking Committee over missing paperwork and political gridlock.
So we have a historic stagflationary shock hitting the global economy and a potential leadership vacuum at the world's most important central bank at the exact same time.
It's a remarkably heavy macro board. You know, I was looking at our notes for this deep dive earlier, and honestly, if you enjoyed Friday's brief relief rally, you really have to appreciate the irony here.
Yeah.
Going from ceasefire optimism to a total naval blockade in 48 hours gives a whole new meaning to the Sunday scaries.
It really does.
Nothing ruins a relaxing weekend, quite like realizing your portfolio is about to run drier than an Irish gas station come Monday morning. You might want to pour an extra strong cup of coffee for the opening bell because our window of market peace was shorter than a supertanker's trial run.
I think we can both firmly agree that Monday is going to require a remarkably strong stomach and a clear head.
Absolutely. But remember the human element we talked about. Extreme panic and extreme volatility create extreme mispricing. Do not let the algorithms or the headlines dictate your long-term common sense.
Before we sign off, I want to leave you with one final macro puzzle to chew on, something that really connects all these threads.
Okay, let's hear it.
We have the massive deficit spending from the One Big Beautiful Bill Act, the OBBA. Yeah. We have this $650 billion AI CapEx supercycle, fiercely driving domestic growth.
Yeah.
And now Those two massive forces are colliding headfirst into a generational energy supply shock. With the Fed paralyzed by inflation, are we entering a brand new economic era where traditional Federal Reserve interest rate cycles simply no longer control the broader market?
That right there is the multi-trillion-dollar question for the next decade. Thank you for joining us on this deep dive into the weekend's chaos. Leave a comment and let us know how you're positioning your portfolio for Monday's open. Stay sharp out there.